Welcome to The Deep Dive, the show that really digs into the details so you don't have to. Today, we're tackling the latest earnings call from Titan Machinery, Inc. That's ticker TITN. We're looking at their second quarter results for fiscal year 2026, the period ending July 31st, 2025. Our mission, as always, is to cut through the jargon, give you the essential performance overview, and maybe understand the big strategic moves they're making. It's definitely a challenging market out there. So let's get straight into it, the headline numbers for the quarter. Titan Machinery reported a GAAP EPS that's generally accepted accounting principles earnings per share of negative $0.26.
Right, and the interesting thing there is that actually beat the consensus estimates. Analysts were expecting, what, negative $0.48?
Exactly. So a beat on the bottom line. And revenue, $546.4 million.
Also ahead of forecasts, but still down year over year, but at 13.8%, if I remember correctly.
That's right. And gross profit landed at $93.6 million, which translates to a 17.1% gross margin.
Okay, so beats on top and bottom lines. Usually you'd expect the stock to pop, right?
You would think so, but what happened?
Well, this is where it gets kind of fascinating. Despite those beats, the shares actually closed down 6.3% on the day they announced.
Wow. Okay, so the market was clearly looking past those headline figures. What else was going on?
It suggests investors were maybe digging deeper, looking at the quality of the earnings or maybe the forward guidance. Something else was weighing on their minds.
Makes sense.
But on the positive side, operationally speaking, they did manage to cut operating expenses, down 2.6% year over year to $92.7 million. That shows some decent cost control in a tough environment.
Okay, let's unpack that a bit more, because inventory, especially in this kind of market, can be a real killer. How are they handling that? It seems like a major focus area.
Oh, absolutely. Huge focus. They've been really aggressive on inventory management. They reported a cumulative equipment inventory reduction. Get this, $365 million. That's down from their peak levels in Q2 of fiscal 25.
$365 million. That's massive.
It really is. And management sounds confident they're going to exceed their original target for the full year, which was a $100 million reduction for fiscal 26.
Wow. So they're way ahead of schedule on cleaning up the inventory. What does that actually do for them financially, though? I mean, besides just having less stuff sitting around.
Well, it has a very direct, very positive impact on the balance sheet. Think about the cost of holding all that inventory, their floor plan and other interest expense. Basically, the cost of financing that inventory, it just plummeted.
Right. I saw that number went from
$13 million in Q2 of fiscal 25 down to just $1.5 million in this latest quarter, Q2 fiscal 26.
13 down to 1.5. That's huge.
It's enormous.
Yeah.
Nearly a 90% drop. That's improved cash discipline right there. It frees up capital, reduces a major drag. It's like paying off a high-interest credit card, but on a corporate scale.
Okay, so that's a huge positive from the inventory cleanup. But,
Yeah.
and there's always a but, isn't there? Here's where maybe the market reaction makes more sense. The margins.
Yeah. The margin story is definitely the flip side of that inventory coin.
Consolidated full-year equipment margins, they're now expecting around 6.6%. That's down 100 basis points, a full percentage point from what they thought before.
And even tougher in their core domestic ag segment. That's projected at roughly 3.8% for the full year.
3.8%, that seems incredibly low. Historically, what would that number usually look like?
Yeah, you're right to flag that. Historically, domestic ag equipment margins, they average closer to 10%, often in an 8% to 12% range.
So why the squeeze now? Is it just the market or?
It's directly tied to that inventory reduction we were just talking about. To move that much equipment, especially in this environment, they're having to offer continued pricing concessions, deals, basically.
Okay. So they're deliberately choosing to sacrifice near-term profit margins.
Exactly. Sacrificing near-term profitability to improve that inventory profile, generate cash, and ultimately strengthen the balance sheet for the longer run. It's a strategic trade-off.
A painful one in the short term, I imagine, for investors watching those margins compress. How risky is that bet? I mean, does this guarantee they come out stronger?
Well, there's always risk, right? The main one is if this ag downturn lasts longer than they expect, or if competitors don't show similar pricing discipline, that could drag things out.
True.
But the potential benefit is huge. A leaner inventory means less debt, less interest costs, and they'll be way more agile when demand does pick back up. So the logic is sound, assuming their timing is roughly right.
Okay, short-term pain for long-term gain. Got it. Let's break down the performance by segment because it wasn't uniform at all. It was a real mixed bag. Let's start with the big one, domestic agriculture.
Yeah, so domestic ag revenue on a same-store basis was down 18.7%, and that led to a pre-tax loss for the segment.
Ouch. And the drivers there, farmer sentiment.
Pretty much, you've got low commodity prices sticking around corn, soybeans, which means less cash for farmers. Plus, high interest rates make financing new equipment really expensive.
So they just postpone those big purchases?
Exactly. But there were a couple of, let's say, encouraging signs. Timely moisture helped crop health in some areas, which is always good.
And the big one, bonus depreciation is back.
Yeah, 100% bonus depreciation. That's potentially huge.
Remind us quickly what that means for a farmer looking at a new tractor.
It means they can deduct the entire cost of that new tractor or combine or whatever from their taxable income in the year they buy it, instead of spreading that deduction over several years.
So it dramatically lowers their tax bill now.
Precisely. It makes those big investments much more affordable up front. It's a direct incentive to buy. Could really help unlock demand if commodity prices tick up even a little.
Okay, definitely something to watch. What about the construction segment?
Also saw a revenue decline, down 10.2% same store, and also posted a pre-tax loss.
Similar story. Economic uncertainty.
Yeah, broader economic jitters, especially around commercial building and housing. Customers are just deferring those big capital expenditures on things like bulldozers and excavators.
But infrastructure spending helped a bit.
It provided some base level of demand, yeah. Roads, bridges, public works. That put a bit of a floor under things.
Okay, now for the star performer, Europe.
Yeah, Europe was the definite bright spot. FX adjusted, same store revenue was up, wait for it, 38.1%.
Yeah, that's massive growth. And it flipped from a loss to a profit.
Turned a pre-tax loss into pre-tax income. Really impressive.
And this was mostly driven by stimulus in Romania.
Largely, yes. EU stimulus programs there primarily aimed at helping farmers modernize their equipment. Titan has a good presence, so they captured a lot of that demand.
Interesting. So a policy-driven surge.
Exactly. But there's a catch there we should probably circle back to.
Okay, we'll keep that in mind. And finally, Australia. The numbers looked really bad there. Down 50.1% same-store revenue. And a pre-tax loss? What happened?
Yeah, that 50% drop looks alarming, but you need the context. It was mostly about sprayer deliveries normalizing.
Normalizing meaning?
Meaning in the prior year, fiscal 25, they were busy fulfilling this huge multi-year backlog of orders for sprayers.
Yeah.
They finally caught up.
Ah, so they delivered years' worth of orders, and now sales are just back to a more typical lower level.
Pretty much. It's not really a new downturn there because industry volumes were already kind of bumping along the bottom. It's more of a reset after clearing that backlog.
Okay, that makes a huge difference in interpreting that number. So a really varied picture geographically. But through all this equipment sales volatility, there's one part of the business that's more steady, right? The parts and service side.
Absolutely.
Yeah.
This is like the anchor for them. While equipment sales go up and down with the cycles, the parts and service businesses are much more consistent. Think about it. Even if farmers aren't buying new tractors, the ones they have still need maintenance. They still break down. They still need parts.
Right, got to keep the old equipment running.
Exactly. And these segments, parts and service together, they generated well over half of the company's gross profit dollars in the first half of the year.
Half the profit dollars from only about a quarter of the revenue.
Yep. Hugely important for profitability and stability, especially now during this equipment trough. And they expect revenue here to be roughly flat for the full year. It's a critical buffer.
That really highlights how important that recurring revenue stream is. It makes them more resilient than just a pure equipment seller, doesn't it?
It absolutely does. It gives them that defensive quality, cash flow, even when new sales are slow. It helps fund those strategic moves like inventory reduction.
Okay, so pulling it all together, what's the outlook? Management updated their guidance.
They did. They narrowed the full year adjusted diluted loss per share guidance. It's now expected in a range of negative $1.50 to negative $2.
Still a loss, but a tighter range. But here's the interesting part I saw. They actually raised the revenue outlooks for domestic ag, construction, and Europe. Australia stayed the same.
Yeah, that seems a bit counterintuitive, right? Raising revenue guidance while still projecting a loss.
It does. What's the read through there? Better sales execution despite the margin hits.
That's likely part of it. It suggests that even with the pricing pressure needed to move inventory, the underlying demand or their ability to capture sales might be a bit better than they initially feared in those segments. And, this overall picture of a soft ag market, low commodity prices, high rates, it lines up perfectly with what the big manufacturers, Deere and CNH, are saying.
Right, they've trimmed their outlooks too. Doesn't CNH call 2025 the trough?
Yeah, CNH flagged 2025 as likely the trough for global ag demand. So Titan's experience fits right into that broader narrative.
And Titan management talked about getting back to historical margins, maybe in fiscal 2027. What needs to happen for that?
They laid out several building blocks, as they called them. Things like finishing the inventory cleanup, seeing industry-wide pricing discipline return, used equipment values need to stabilize.
Okay.
Plus optimizing inventory geographically, keeping strong partnerships with the manufacturers like CNH, and just having a leaner cost structure overall. They do expect significant improvements sequentially through fiscal 27.
Sounds like a plan. Which of those building blocks seems like the trickiest one to get right?
That's a good question. I'd say the industry-wide pricing discipline and stable used equipment values are probably the toughest.
Why those two?
Well, pricing discipline requires everyone in the industry to hold back on deep discounts, which is hard when inventory is high. And used equipment values. They're kind of linked to new demand. If used prices keep falling, it pressures new sales. The other things, like cost structure, are more in Titan's control.
Makes sense. Some external factors need to cooperate. One last point on strategy. Their approach to trade-ins. They said they quote everything but use data to evaluate. Is that a way to grab share now?
It could be.
Fair.
By being willing to engage on every potential deal, but using data to make sure they don't overpay for the trade-in, they stay active in the market. It keeps customer relationships going and might let them pick up business from competitors who are maybe more hesitant right now. Sets them up better for when the cycle turns. It's playing the long game.
Right, an offensive move disguised within a defensive posture. Okay, fascinating stuff. Now, let's pivot to our This Is Not Financial Advices segment, purely educational, maybe a little entertaining, where we pitch an outrageous but plausible trade idea.
All right. So let's think about the setup here. The market reacted negatively to Q2, right? Focused on those squeezed margins, even though they beat estimates and made huge progress on inventory.
Yeah, the market seemed focused on the immediate pain.
Exactly. And management is explicitly saying, we're trading margin now for balance sheet health later, and they're pointing towards a margin recovery in fiscal 27. Plus, we have that specific European stimulus goose that's going to fade.
Okay, so a disconnect in time horizons and a specific near-term event. What's the trade?
Okay, here's the idea, playing both time frames. First, for the longer-term recovery story. Consider a long call spread for FY27 expiration.
A call spread. Buying one call, selling a higher strike call, same expiration.
Exactly. Betting on a moderate rise by then tied to that margin recovery. For example, maybe buying the January 2027 $20 strike call and selling the January 2027 $25 strike call against it. Limits your cost, defines your potential profit if PITN gets back into, say, the low $20 by early 27.
Okay, that's the optimistic long-term piece. How do we make it outrageous but plausible and account for the near-term headwinds?
Right. The outrageous part is you could try to partially fund that long-term bet by playing the near-term pressure. Execute a bear call spread for Q4 FY26 expiration.
A bear call spread. Selling a call, buying a higher streak call, betting on the stock staying flat or going down.
Precisely. For example, maybe selling the December 2025 $22 strike call and buying the December 2025 $27 strike call. You collect a premium for selling that spread. It specifically plays on the ongoing margin pressure A&D. Importantly, that expected pullback in Europe in Q4 fiscal 26. Remember the Romanian stimulus?
Oh, right. You said there was a catch. It expires.
It expires at the end of September. So Europe should still look great year over year in Q3, but management guided for about a 20% pullback year over year in Q4 once that stimulus money is gone.
I see. So the short-term bear call spread bets on that European slowdown and continued margin pressure hitting sentiment later this fiscal year.
Exactly. You're using the premium from the short-term bearish bet to help pay for the long-term bullish bet. You capture the near-term negativity that worried the market while positioning for the eventual recovery they're planning for in fiscal 27. It's playing multiple angles.
That is definitely an intricate strategy, very hedge fund analyst-like. Okay, let's wrap this up. To recap, Titan Machinery is clearly working hard through a tough equipment cycle. They're making really impressive progress on cutting inventory, cleaning up the balance sheet.
Even though it's coming at the cost of near-term equipment margins, that seems to be a very deliberate, strategic choice.
And they have that steady parts and service business providing a foundation.
Yeah, plus a clear plan, those building blocks, aiming for margin recovery in fiscal 2027. It feels like a methodical approach to get through this trough and come out stronger.
So the provocative thought to leave you with is this. Will the market start giving Titan credit for that long-term strategy and the balance sheet improvements before the margin recovery actually shows up in the numbers? Or will the near-term pain keep dominating the narrative?
A classic battle between short-term sentiment and long-term execution. And of course, as always, this discussion was purely for informational purposes. It should definitely not be taken as financial advice.
Absolutely. Thanks for tuning into the deep dive for this look at Titan Machinery's Q2. We hope you found it insightful.